Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
All right, welcome back to the Gentle Art of Crushing It podcast. My name is Randy Smith, and I'm going to be the host today. And I'm really excited to have with us Sandhya Seshadri. Sandhya is the founder of Engineered Capital. She is a general partner that focuses on all aspects of multifamily syndication. She's got $140 million in assets under management with 3 full-cycle deals and 5 current deals. So, Sandhya, thank you so much for coming to the show. Welcome.
Thank you so much for having me, Randy. We've known each other for a few years over different, groups and circles, and it's really nice to have this conversation with you. And congrats on starting a podcast.
Yeah, thank you. I was thinking back to when you and I first met. It was some conference, I'm not sure. Mm-hmm. And I remember just being shocked that you would even stop and take the time to talk to me. So thank you for that, because this was probably a couple of years ago when I first met you. So that's one thing I love about you. You put yourself out there. You seem to help others a lot. And surely that's why, or a big part why you've been so successful. So why don't we just jump right in if we can, Sandhya? And can you tell the audience a little bit more about yourself and how you found yourself to be a multifamily syndicator?
So back in the day, I came with 2 suitcases in hand as a student to Dallas-Fort Worth and started with $8 a week as my food budget. So I really know the value of $1. I know how far I can stretch a budget. Came with a full scholarship, got my engineering degree, went into the corporate world, love my numbers. And so that really translates well to multifamily in the sense of underwriting. The way I got into multifamily is that I also went to trade stocks for several years and got my MBA part-time. So now I had a kind of a problem. If my husband was a W-2, so was I. I was looking for something to offset my taxes a little bit because neither of us had any kind of a side business, etc. And then once we had children, it made sense for me to quit the corporate world. And so that led to stocks and real estate. So I still do both of that. I attend a weekend event like many of us do, and it seemed straightforward enough because I didn't have a handy person background to fix a leaky toilet, and I didn't want to deal with the 4 T's we talk about, the tenants, toilets, trash, and termites. So when I heard that what we do is large-scale multifamily, 50, 100 plus doors so that the property generates enough cash flow to afford third-party management and have on-site staff. It made sense to me. My project engineering background was very well, fitted to asset management and underwriting. So I do both. And I live in Dallas, which has been a great market for multifamily over 30 years. So the minute I look at a deal and I have its address, I already know if I'm interested in that location or not. So a lot of things came well together, meshed well for me to do multifamily investing in the Dallas area. So that's what I do full time, and I still trade stocks.
I love it. So yeah, I didn't realize the trading stocks piece. That is generally you have real estate people or stock people. And interesting, I was talking with a friend over the weekend, and he has everything in real estate. And there are some interesting things going on in the stock market today, which makes it ever more important to have a well-balanced portfolio. So I'm curious, with your years of experience in stock trading and in real estate, when you look at your portfolio today, how do you break that up? What percentage do you keep in real estate and what percentage do you keep in the stock market?
I've actually had more liquidity from the stock market. And because the last couple of years, the real estate market hasn't been as great in terms of, cash flow, et cetera, because of the interest rates climbing, there haven't been as many deals. So I'm grateful for my portfolio in the stock market. If I could pick a number, it would ideally be 50-50. But obviously it keeps balanced, right? Rebalanced because, the value of your RE portfolio changes on a daily basis depending on interest rates and cap rates, and the same with your stock market portfolio. But in general, I always advocate for people having at least 6 months of living expenses liquid. before they
Got
take
it.
money to put it into other things. And actually, I put a lot of my retirement money into real estate in terms of passive investments because that's my way, at least at the beginning, to get to know new sponsors, general partners, see how they operate, take the
Yep.
best from each of them to incorporate into my own deals because that's money I can't invest in my own deals. And of
Hmm.
course, I still have, a good portfolio in the stock market. And my husband's a W-2 employer in the engineering world. So a lot of his 401k, et cetera, is quite, unfairly balanced tip towards the stock market. So I do a
Sure.
little more of real estate. But as a family, we try to keep it even.
Are you interested in real estate investing but don't know where to get started or think you don't have the time or money? Are you stuck in your W-2 because the golden handcuffs make it hard to walk away? If this sounds like you, check out impactequity.net and schedule some time to talk with the founder, Randy Smith. Randy went from massive income to leaving his W-2 through passive income, and he can help you do the same. www.impactequity.net.
I love that. I love, and I really like the fact that you encourage folks to have 6 months worth of liquidity. I think that just goes back, to a principle that I share with folks as well. Like it's really, really, really important to have your financial house in order before you start investing in the space. This can be the greatest benefit in addition to your investing portfolio, but it can also put you in some situations if you have all that money tied up and you don't have any liquidity as well. So I thank you for sharing that. I think that's important. And a lot of times when you're talking with real estate people, they don't like to share that, the stock market is a good place to hold a portion of your capital too. So hats off
It
to
is,
you.
and you hear a lot of people talk about a diversified portfolio. Well, 100% real estate is not a diversified portfolio. Neither is
Not at all.
100% stock market. So I
Yeah.
actually like a variety of assets, but I'm more passive on the other kinds of assets, like whether it's oil and gas, or sometimes I'll delve into self-storage or some other investment option. So
Okay.
there's a high risk portfolio, there's a stable portfolio, there's the cash flowing side, etc. Right? So what
Yeah.
makes sense depending on the phase of life you are in, right? When do you
Yep.
need more of the liquidity versus a little bit less, and so on? So what is your time horizon?
Okay. Well, I'm curious your thoughts then. So generally the type of people, I work with people that are very similar to me or have similar backgrounds to me. And I was a high income sales guy. And when I was in the W-2 role, I was not a cash flow investor at all. I was more of a growth investor until the point when I got laid off. And then all of a sudden I became a cash flow investor overnight. So I'm curious, what kind of guidance, but I know that we're not financial advisors. We don't give advice, but what is your opinion around what that mix should look like for somebody who is a high income earner and potentially has 10 plus years left in the workplace?
I would still have 6 months of liquidity always for
Okay.
whatever you might need for your current standard of living. I would
Yep.
also look at whether it's retirement or a kid is going to college, etc., types of expenses you have coming up in the near future. If
Mhm.
you're going to be confident of working for the next 10 years, either for yourself or your existing employer, like let's say you get laid off next week, are you prepared? Right.
Yep.
And usually layoffs happen around the end of the year, right when you're thinking of, shopping for Christmas, etc. So
Yeah.
are you prepared for that layoff by having multiple sources of income? I always look at that. But if I had a 10-year horizon and let's say I had $1 million sitting in 401k accounts from prior employers, because I've
Yep.
already been in the workforce for that long, so I must be in my 40s, at least if I'm looking to retire in 10 years, I would put a good chunk of it in real estate. And now is a good time to buy. And I would put
Yeah.
it as passive investments because my busy professional job, I got to stay up to industry. And if I get laid off, I got to go find another job kind of situation. But I would
Yep.
definitely not allocate more than 50% of any portfolio into one asset class. That's just my philosophy.
I like it. I like it. So you go one step further and you like diversification within real estate,
Mhm.
even within asset classes as well. Okay.
Correct.
Excellent.
Correct. I
Excellent.
mean, if short-term rentals are so cool, I would talk to somebody who's done full cycles and try to get into that, or
Sure.
self-storage. But I would stick to markets that I'm familiar with, right? If somebody
Okay.
says the next biggest opportunity is out in Midland, Odessa, I'm not as convinced as I am if you say, okay, it's the Carolinas or it's, Midwest or a market that's already proven itself with a diversity of employment.
Very good. Okay. And I would imagine being pretty heavily vested in the multifamily space, that probably is the majority of your, or at least a larger percentage of your real estate holdings. Is that
Correct. It
accurate?
is. It sure is.
Okay. Okay. You
Yeah.
and I think, are very similar. I've got probably 70% of my real estate holdings in multifamily. And then I also
Correct.
have some self-storage. I even invested in an ATM fund. I'm kind of having some regrets on that right now. But a bunch of different types. Yeah. Okay. Well, let's kind of step back a little bit. I'd love to hear how that journey started. You mentioned that you went to, one of the infamous weekend events that we hear so many people talking about, and so many people have gotten so much value from that. What did that process look like for you? Did you jump in day one and join a mastermind and find your partners and get going, or was it a little bit slower?
I already knew before attending the event that I had this in mind. I knew what they were going to pitch, and I had already kind of made up my mind that this was something I wanted to get into. And I specifically looked at Brad Sumrock's program because I'm based in Dallas, and most of his events are in Dallas, which meant it would be easy for me to go to his events. He has 6 in-person events a year, every other month. There's like a bus tour, as an example. And a lot of the syndicators in his group had properties in Dallas, which means I'm more networked with people who are doing exactly the business in the markets that I'm interested in. And if you will, the headquarters is also Dallas. So that's why it was an easy decision for me. I kind of already made up my mind before I attended the event that I was probably going to join. And I started right away investing passively because I was no longer in my W-2 and I had that money. And so I put it into a self-directed IRA and invested very strategically with a few partners with whom I wanted to build a relationship so that in the future I could, let's say you wait 2-3 years. At that time, every 2 to 3 years, people were selling their properties. And if I have 2 years of monthly, updates on a property and I want to buy it because it's still a great property, that's one thing. But also to have connections with peers to know what these things cost for you and your operational expenses and running a property, etc. So if I put $50K with an operator, I can call them up and ask them how are things going, as well as specifics to my deal when I am running my own deal. So the relationships are important, and people will give you time, especially when you invest money in their deals, and they'll help you out later. So the relationship building was great. So immediate passive investing I did right away, like within a couple of months. But then about 8 months later, we had closed and acquired my first deal with more experienced partners. And then it's like they say, the law of the first deal. Once you get that first deal, the second, third deals flows pretty well. And my goal was always to do all aspects of the syndication rather than become a specialist as one, because I wanted to be able to jump in and cover any aspect as needed in case, my partner gets hit by a bus concept. I didn't want to be completely clueless. So I started really learning the asset management side. What happens from, day 60 for the next 5 years till you return money to investors? That's the longest phase. And so I really wanted to learn that. And my partners were out of state. COVID hit us. They couldn't travel. So they would direct me. They would tell me what was going on. Right? I was on every weekly call, but I'd be the one to show up to the properties. And so I learned a ton that way. So asset management kind of became my wheelhouse, if you will. But I have to underwrite deals myself. Even if a partner brings me a deal, I have to independently underwrite it. I drive my properties at night, etc. So all of that has led to me feeling confident about being able to step in any role. If a team member comes in and says, hey, I really need you to cover the legal side, or I need you to work with insurance, or I need you to do the, loan legal aspects, or all of the PSA negotiating, etc. Right. So I'm able to step into any role, and I really like that. For me, I need to have that whole comprehensive knowledge of something before diving into this level.
That was a mouthful. You covered. I've got 18 questions from that one blurb that you shared there. But no, I love the fact that you said that you looked at a community that was close to you. I hear so many people that join masterminds or communities, and then they got to fly across the country to go to the events, which adds another $2,000 to the event cost. And that adds up over time. Also, just the simple fact that you get to network on a weekly, monthly basis with the people that are in your mastermind, because they're probably attending the same meetups you're going to as well.
Correct.
I suspect.
Correct.
So yeah, that is such a good deal. I really like the fact that you said you decided to passively invest before you went active. And that's the same route that I went as well. And I get so many people that come to me that want to get involved in the space, And I think they're trying to make a quick buck and they don't have money to invest themselves. And,
Correct.
time after time, my advice to them is invest in the deals, because how can you possibly suggest that somebody invest in something that you're not even doing yourself? So I think, hats off. I'm following your playbook and I didn't even realize it. So, and then this idea that you are involved in all aspects. And I think that's different. I've become more of a specialist, and now I'm trying to turn into a generalist. And it sounds like you were a generalist that became more specialized after getting experience in everything. So what kind of benefit do you think does that bring to your investors when they're partnering with you, because you have full knowledge across all different aspects versus just one category?
In a way, it's like one-stop shopping. If they have a question about the deal, I can tell them exactly what's going on. I don't have to pull up spreadsheets to tell you what's going on a year or two into the acquisition of the deal, because I'm so involved. I'm the one who goes to the properties. I'm within 30-minute drive of all my properties. I'm in the asset management calls. But I also remember what I initially underwrote, because even if a partner underwrote it, I would have also done my own underwriting and made sure the numbers make sense. So when you say budget versus actual in a report, I know what I budgeted 3 years ago for rents.
Yeah.
So people might say, oh, maybe rents are slowing down, etc. I look at my assumptions and I go, well, I only assumed a 2% rent growth after year 2. So I'm right on track. I'm not seeing any, difference from my initial underwriting. And that comprehensive understanding is important to me. I also know what, for example, exit rate cap I underwrote for. I know what I underwrote for my tax and insurance increases, which to some extent are non-controllable. So the benefit to investors would be that it's a one-stop shop. I have all the answers, or I know where I need to dig in to find the answers. And they don't have to worry about talking to somebody who's not in charge of the deal, because I'm in charge. I'm a general partner signing the loan and a voting member in my deals. And that's important to me.
I love it. Yeah, great
That's
information.
how I differentiate.
Yeah, and I think that's a big way and really important way to differentiate yourself as well. And I've seen it from observing you on the sidelines for years now, how heavily you're involved in all your deals. And I see the videos on LinkedIn where you're walking properties at all hours of the day. And it's exciting to see how involved you are with all of these assets. And it makes me feel as an investor, it would be very comfortable with me putting dollars in your deals because I know how heavily involved you are.
Yeah, there's no surprises. I'm not somebody who hasn't gone to my property in 6 months and is surprised at the state of the property. No. By the time I go shopping and come home, I've probably driven by one property. By the time I go from my home to the Dallas-Fort Worth airport, I would be passing 3 properties. It's like that. So it's easy for me to visit my properties. It's not that much of an extra effort.
Love it.
That makes a difference.
Well, let's jump in if we can to kind of the current state of the economy. Actually, you know what? Before we do that, let's talk about asset management, because that really is kind of your forte, and you've really grown a very good brand for yourself just on social and everything that I see about you. So tell the audience, if you can, like, what does asset management mean? Like, what differentiates asset management versus property management? I remember being confused with that when I first got started. So let's start there.
So asset management is a little bit at a higher level, like a helicopter view of the property, versus property management is more at the street level. Okay. So sometimes as an asset manager, the things we look for are more strategic in nature and less tactical. And one of them is right from the beginning being involved and looking at the underwriting and saying, is this realistic? Can we execute to these numbers? So even if you are not the one who underwrote the deal, you need to be able to look at those numbers and say, are those rents realistic? Are those expenses in line with properties of that vintage in this area? So you basically are the sounding board for every input into that analyzer spreadsheet. On a strategic level as an asset manager, something I'm doing this year especially is looking at refinancing. The Fed announced rate cuts. So do you understand what that means in terms of SOFR versus just treasuries? And so what type of loan you're getting into and which one affects which? So if you're waiting till September 18th Fed meeting as an example, your U.S. Treasuries, whether it's 5 year, 10 years, is not going to be affected the same way as SOFR. So if your loan is impacted by SOFR, you should be waiting for that date to see what that announcement is going to do for you. So even those kind of aspects is not something your property management company is doing. They are looking at very tactical aspects, which is your day-to-day leases, your maintenance requests, any other inspection requirements, etc. So as an asset manager, I want to be involved on anything that impacts the safety, the health, and the well-being of my residents. So code compliance is very important to me. I want to make sure we do everything right per the city's requirements so we get our certificate of occupancy. I want to make sure basic necessities like it's 9,600 degrees outside. My air conditioning system should work. There should not be even a day when the AC is out in one of my apartments. So I want to be informed on those things. But I'm not the one who's going to call and get 3 different bids and get the stuff repaired and the properties, the parts ordered, etc. Right? That's part of the property management company's job. I'm involved at a high level in executing the business plan, but especially in managing risk. So I'm starting to look ahead, just like a project manager in my engineering world. You kind of have to look at what is the critical path to executing your business plan. You kind of watch out by looking ahead at things like, what are my trends? What is my exposure? Like if I have 20 leases all expiring in August, I need to look at staggering them, 11 months, 13 months. So I have a more strategic look and I make sure PM executes on that without being a micromanager. But you have several KPIs that you look for that you already know, okay, this trend is not good. What's going on? Let's go dive in. Let's solve it now. And so those are some of the aspects. But of course, there's the investor relations side of things. There's the lender side. There's the legal side. There's the code compliance side. So you kind of juggle all of that as an asset manager.
Okay. It sounds like you got your hands full with 5 current assets there. I think when we spoke in the last couple of weeks or so, you actually mentioned that you will go sit at the property in one of the offices and kind of watch day-to-day operations and just be available. What would you say is the benefit of doing that versus managing, over Zoom or over the phone? Curious your thoughts there.
Your presence in the office, right, indicates how important that property is. One, you can buy lunch for the staff and get to know them on the inside. How are your kids, etc. Just the relationship, and to say what you do is really important to me. Like right now, I'm in the middle of trying to refinance a deal. So my property's performance must stay where it is or better. That's what my loan agreement says. So if that dips, it's a problem. So I want my PM to know that every $1,000 that they collect in my rent every month makes a difference in my proceeds on my loan. And so their job is extremely crucial. And I want them to understand how important they are to me. But by my sitting there, I sometimes do that, especially when we are transitioning property managers or when we are in a new acquisition mode, because a lot of systems aren't quite set up. They don't quite know what to do. They're not sure just how much they have authorization to do. So they can ask me a quick question. I say, yes, go do it. Go get that equipment. You need that right now. I'd rather you do that. Go to the Home Depot now, buy that, than wait for a contractor who's going to come 3 days later. That's important. We want to go fix that right now. So I can judge the importance and how critical something is and immediately authorize things, and that's important for them. But otherwise, it's a door shut. It's a side office. I sit there. I'm not like listening to every conversation kind of thing. I'm still doing my emails, doing my work, but I'm available for them. And I'll take periodic breaks. I'll walk a unit with them, etc., if they want to show me something. So I spend enough time to get to know the team.
Love it. Yeah, no, and I think that's probably one of the big values that you bring to your projects that you're working on is you don't hear that level of detail from folks that might be out of state. They certainly can't visit the properties as fast or as often as you are, and hard to build those relationships. I would imagine you get the same thing we had, like, corporate is coming to town. And everybody puts on their nice clothes and smiles and presents well, but true day-to-day operations aren't happening like that. So when you just become another kind of cog in the wheel, and you're working right alongside them to drive the same returns and results to your investors and your tenants, I think you build a lot of credibility with your workforce and everyone as well. So that's great.
Yeah, another big thing that happens real quick, I want to say, is on the weekly calls, they'll tell you, we have 7 move-ins happening this week on Friday. Great. That's wonderful. That means my units have not been vacant for as many days as, you initially had predicted. So what do I do on Friday? I show up. I say, let me
Mhm.
walk those 7 units. Or I might show up on that Thursday afternoon and say, show me the keys and give me the unit numbers. I'm going to go walk these 7 units to see what level
Mhm.
of readiness they are.
Sure.
And it turns out only 4 are really ready. The fifth one
Okay.
still needs a part. There's still something going on. So when you do that repeatedly, they realize whatever you tell me on the weekly call on Tuesday, I'm kind of going to check that. It's a trust but
Yeah.
verified system. And
Yeah.
soon they realize you're serious. And so less of that happens. Is it fixed? Is it really ready? Send me a picture, send me a video. That's a good way if you're remote to do that. Is
Okay.
just
No, I
go
like
into
that.
that unit and send me a video or FaceTime me. I want to see
I
that
like
that
that.
unit's really ready.
Yeah, and I think if they're transparent and they're honest with you, you're going to be more receptive to that than if they're not telling the truth and then you go find some holes what they're sharing. I used to have a leader where he would come in and he would very specifically look for areas that were different than what you shared with them. And our goal was always like, let me tell you what's wrong first, and
Correct.
then then the rest of the presentation is very, very easy. If we start with the bad news, then everything else is good news. So yeah, very
And
interesting. It's a different strategy around asset management than what I've heard from a lot of the operators that I work with. They're more hands off. They might be more heavily involved over the phone, but to
mhm.
be able to be there on a regular basis, I think that can be really important. So
I mean,
yeah,
it's a
great job.
competitive advantage, right? If you could do it, you would do it. If I had as many properties as some of the big people, I probably can't visit as many on a regular
Sure.
basis. So then I'd have to employ asset managers or rely on partners to do that. But I haven't scaled to that level. So I still, 5 properties. You know what? I could visit them every other week for sure.
All right. So, yeah, thanks for walking through all of that. I think you bring such an interesting perspective to the table with your background and really your ability to focus on all aspects of the syndication space. So, I'm curious, taking a look at the market today, do you think now is a good time to be buying? Is it a good time for investors to start getting some money into play now? Or what are your thoughts about the current state of the economy?
I think if we're not already at the bottom of the market, we're pretty close. And I do believe that 2 or 3 years from today, prices will be going up. I do believe interest rates and cap rates have stabilized enough. They will start only going down and not really increasing further. That seems to be the biggest indicators we're seeing. But ultimately, it's about the underwriting and it's about finding that bargain. Like I'm an immigrant at heart, I hate paying full price. So if
Yeah.
you find a deal to where the rents at that property are far below the market rent, that's the number one thing I look for. That means somebody has been holding it for a while and hasn't bothered to increase the rent. So like a couple of the properties we got were from the original builder's son sold it to us. So it had never
Hmm.
been sold to anybody else. He had owned it. He never had the need to increase the rent sufficiently. So that's an example of a bargain to where your rents are far below market. So you're not expecting a huge rent growth in certain markets. So it's got to come from the property itself. And you've got to have a strong system for delinquency management.
Okay.
And you've got to have a customer focus, and your customer is the resident. Take good care of them. You will build a community. You will have very high retention. So we target a minimum 60% retention, but really like it to be 100%. We really want to know that the person is leaving because maybe they're buying a home, etc. So when you
Yeah.
focus on the fundamentals and find a property, I think that, real estate ultimately, if you look at it as illiquid and long term, that means you have
Mhm.
at least a 5 year horizon. It's going to be a great investment. It's going to be a great addition to anyone's portfolio for a well rounded and diversified portfolio. So, yes,
Yeah.
I'm all in on certain markets, again, based on the deal itself being in a very good, high diversity of jobs market.
Love it.
Job growth, population growth,
Yeah.
all the economic indicators, and low crime. Yes, you
Okay.
can still buy deals. There are still deals to be bought.
Awesome. Yeah, no, I agree with you. And I think every deal's got to have a story. There's got to be
Hmm.
something that is giving you some advantage.
Hmm.
And I love the type of opportunity that you're talking about where it's maybe a single owner or,
Hmm.
a child of the original builder. Like
Correct.
what a great
Mhm.
opportunity that would be. Or, it's just some other thing that's going to give you some advantage. Maybe you're assuming a loan. Maybe there's some great affordable housing technique or strategy. Um,
Correct.
I agree. So very good, very good. So, well, this has been really interesting, Sandhya. I love your perspective. I love your energy and excitement and enthusiasm in the space. And it's been a pleasure having you on the show. I do still have a few questions I like to
Mhm.
ask everybody. So if you have a few minutes, I'd love to jump into those.
Of course.
All right. Well, keeping in mind that the avatar or the listener is probably newer to
Mhm.
the passive investing space, what would you say is a great resource for them to start or continue their education journey in this space?
I think there's a lot of podcasts that have a lot of really good information in them. And so the famous ones are like the best ever podcast, but there's newer ones like yours. Yours has been around at least a couple of years.
Yeah,
And I like the mix of both. I like the experience and how things sounded back then versus what things are happening today. I also like the lender's perspective. So I like to listen to like an old capital podcast just for that, because the right debt is also very important in multifamily. So I would look at both.
absolutely. Okay. Yeah, and thank you for
Mhm.
suggesting Old Capital as well. It is one I've been listening to now for about a
Mhm.
year, and I think it gives a very unique perspective from some guys that have been around for 20
Mhm.
plus years. Quite often,
Yep.
they have a number of different people on there. I think I really like that one. Um, yeah, so great. Now, I'm curious for yourself, are there any specific podcasts that you're listening to more so that you're excited about, whether it be business or professional growth or mindset or anything like that? Is there anything that you're excited about today personally?
I'm still a Tony Robbins fan. I listen to a lot of things by Tony Robbins. I like Ed Milet. I like David Goggins. I like all of their books and any resources from such inspirational folks in a variety of ways. I also love Ryan Holiday for his books on Stoicism and to just have a very even perspective that things happen. Don't take it personally and emotionally. Just do what you need to do and what's
I
within your control.
I love it. I mean, you and I are cut
Mhm.
from the same thread there. Definitely. Like I am a huge anything Ryan Holiday, anything Benjamin Hardy, Tony
Mhm.
Robbins.
Yep.
I listened to Ed Milet earlier today, actually
Mhm.
at the gym. So um, that's great. Very good. Okay, so let's see here. We spent a lot of time talking about due diligence, not only on this show, but on previous shows as well. And I'm really trying to continue to refine as I feel like the due diligence process needs to continually grow and get better and better and better. So
Mhm.
I'm curious, are there due diligence questions that you think investors should be asking that maybe aren't, like what is your track record? What are the returns that you've done? How many full cycles? Like, are there some other really good due diligence questions that they should be asking that are a little outside of the norm?
Tell me about how your deals have done in the last 2 or 3 years, and especially when something went badly. What did you and your partners do about it, and how did you overcome it?
That's the classic interview question too, like
Mm.
asking
Yeah.
like, tell me about a difficult challenge and how you overcame it. And the person that responds with, we've never had any challenges. You know that they've not been in the space. So if they've been
Yeah.
in the space for any amount of time at all, there's been some challenges. So I love that. Finding out how people show up when things get hard, because
Yep.
anybody can show up when it's rainbows and unicorns, but
Hmm.
when it's challenging, that's a different story. Okay. Well, now just a couple of kind of fun questions to know you a little bit better personally. Um, there is this idea around bucket list, and I'm a big bucket list guy. I've always had bucket list experiences that I've been chasing. Do you have any recent bucket list experiences that you've checked off your list, or any you're hoping to in the near future?
Travel is always on my bucket list, and I was
Yeah,
finally able to get enough miles to actually fly on a flatbed across the Atlantic Ocean, and so that's pretty exciting. When I don't spend, $7,000, $8,000 for a ticket, and it's with points, I always like
yeah.
that. But I've been to Iceland, Kangaroo Island, and places like that. And the next one on my list is South America and Antarctica. So
Very
hopefully that'll
nice.
happen one day with points.
Yeah. Absolutely. I think I've shared with you, I worked for American Express for 10 years. So I am a
Mhm.
points junkie. I used to help teach people how to use points.
Mhm.
And my wife and I got to go to Spain last year or the year before in those lay down Delta seats as well, all free.
Nice.
Um,
Yeah.
there's nothing better than flying lay down seats other than
Yep.
not having to pay for those.
Correct.
So
Exactly.
all right, and then one final question here. If you had $100,000 that you had to invest today, but you couldn't put it into one of your own deals, where would you place that capital?
I would put at least half of it into something very liquid that I could access. And then I would put the rest of it into a multifamily deal with an operator with whom I want to build a stronger connection, or on a property that I couldn't get, but they're getting. So hopefully in a few years I can.
I love it. I love it. Awesome, Sandhya. Well, this has been a lot of fun. You bring, as I mentioned, you bring so much energy and expertise and drive in the space. It's just been inspiring to get to know you a little bit more, and hope to be working with you much more in the future. But thanks so much for being on the show today.
Thank you so much. It's been an honor. You are amazing. I'm so glad we connected.
Awesome. All right. And to the listener, as always, we encourage you to continue your education journey in the passive investing space. But more important than that, make the decision to invest in your first or your next deal. Both Sandhya and I are convinced that once you do, you will wish that you had just started that much sooner. So thank you again for listening today, and be sure to join us next Thursday for another great episode. Thank you.
Well, there you have it, ladies and gentlemen. Another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.